U.S. markets obviously were closed last night for Labor Day, which really marks the end of summer. I think we mentioned yesterday that's usually the time when kind of all the fund managers return in full force. Everybody comes in, they start to look to position toward the end of the year. Usually we see volumes and pick up, and sometimes some deal making, that sort of thing, start to really pick up because everybody's back in the city there in New York. In Asia overnight, it's a bit mixed action, and the Nikkei down, but everything else is pretty much up. Australia surprisingly up over 1%. The resource sector traded well for the first time really in a while. And I think just a little bit of a dead cat bounce. I mean, it's fallen about 10% if I'm not mistaken in maybe 6 or 7 sessions. So it's really taken quite an aggressive beating. We have China, which is up at the moment, so it's kind of been zigzagging back and forth. I think it's starting to push here down into the close again. It was up about as much as 3.5% at one point. It was down in the red at a point. We had trade balance numbers there that were actually relatively solid, with the Hang Seng now starting to push as well. We're up 1.75% on the Hang Seng, so it's starting to get a little bit of a maybe solidity out of Asia. It hasn't been as wild over the last 2 or 3 days as it had been maybe for the preceding 2 weeks. Chart of the day here, and this is a chart that I was looking at yesterday, and I think that this to me actually is potentially one of the most important charts that we can look at. In the article that I was reading, I was talking about the Chinese reserves, foreign currency reserves, and then they came out with them yesterday. They announced the foreign currency reserves at the end of August, and they had fallen by $93 billion. And the previous month, they had also fallen by $50-odd billion. So, and what's happening here is that China runs a peg on their currency and to the US dollar. It's a bit of a floating peg, but it's a peg to within a percent or two. And what they've been having to do is they've been having to sit there and buy yuan in the market. So they're selling their dollars or their sterling or the euros or whatever it may be in the market and buying yuan in order to hold the yuan up. And they've had to pump $150 billion into just keeping the yuan where it is over the last month and a half, and that's with them devaluing the yuan by about 7%. So when you factor that in, I think it's a huge, obviously it's a hugely negative sign. But if that continues, that's gonna end up forcing them most likely to devalue the yuan again. And if you remember, only a couple weeks ago, what happened when they devalued the yuan, that really actually set off the proper carnage that we saw in equity markets. So I think very quietly, this is maybe potentially one of the biggest stories in the entire financial markets at the moment, and no one's really talking about it. So just keep an eye on that. I think keep that in the back of your mind. If you see that China comes out and they devalue again, which probably, like we said, I mean, they had to throw almost $100 billion at it last month just to keep it in line after they weakened it. So there's only so long they can do that, even though they've got 3-point-something trillion. It runs out quick when you're doing 100 billion a month. And it's you can see here that this chart's showing us that the Chinese people and companies are smelling this, and they want to get the money the hell out. And so this is actually, it's picking up at the moment and not decreasing. So just keep that in mind. It could really be a bit of a mess for the foreseeable future. All right, we got Steinhoff out a little bit later today. Headline earnings per share consensus expected to be around 427, revenues at 134.81, and dividend per share 160. Keep an eye out for that. Could be a real mover later this afternoon, especially if they beat with the rest of the retail sector having missed. We had the current account balance out of Japan this morning, a little bit better than expected. GDP actually coming in better than expected as well, quarter on quarter. We've got GDP quarter on quarter in the Eurozone at 11 and year on year at 11. And then we had Chinese trade balance numbers as well, and those were definitely a little bit better than expected. All right, let's get into some of the maps. Okay, first thing we're going to look at this morning is US dollar ZAR, which obviously, sorry, let's put in a monster move up to 14. We traded a hair across 14 last night. And what I wanted to show you guys, and it's hard to see right up here, is the previous top. Now this is on a monthly. Unfortunately, I can't pull daily data back this far. This is a 20-year chart in the Rand. There's a couple things that we'll look at here. And that's one, obviously, how steep this ascent was, which is actually was worse than what we've seen now. But look at the period of time that we've seen this devaluation that's happened. It's happening since 2011, really, until now. So we're looking at 4 years strong at the moment. We actually saw a longer devaluation. That's probably a little bit unfair comparison because it's coming on the back of 1994. But what I'd like for you to look at is maybe here. In 1998, that was really where we triggered a bit of an emerging market rout. Okay, and this is the Russian debt default. This is the LTCM, all happening kind of here amongst this sort of space. And you see this initial spike, very similar to our initial spike here. Okay, you see that same sort of consolidation, and obviously it looks a little bit different, right? But it's at the same time, it's not so drastically different. You can see that the major spike, we put in some consolidation. We never took out the lows or the highs of that spike for a whole year. I mean, we're looking at a quarterly chart. The same sort of thing here. So we didn't see the highs taken out until about late 99 or early 2000s. And when it did, it just really tripped, and it tripped out hard. It's looking very, very similar when you look at it. And you look at this move. This is a move started in 1998, finished in 2002, and it finished with an unbelievably steep move. So the move from 10.5 to 14 was obviously dramatic. I would say that our move from about 11.5 to 14 now is looking dramatic. So, technically, if you want to look at this chart and you want to look at it kind of like that, we've got a hell of a long ways to go in terms of the breakdown of the Rand and where it's going to actually trade to. I'm not saying that that's what's going to happen, but the one thing that is interesting to look at in this, and I'm trying to gauge, the last time that there was such an emerging market currency rout was here in '99, and that's about how long it took to play out. You can see how steep it was. It wasn't just in the Rand; it was in a lot of the other emerging market currencies, and then you had a really V-shaped move back to the upside from there. Now that was when the U.S. started chopping interest rates in 2001, and that's really drove the commodity boom. And you had China obviously firmly on the back of that. So whether or not that same sort of V-shaped recovery can happen, who knows? But the fact of the matter is that things are getting interesting here. This move is starting to look almost as long in the teeth as our move that happened from back in '98. I want to say that it maybe has a little bit more legs on it. One of the things that I think that really is pointing it out is when you look at the 10-year yield in South Africa, and we're starting to move a lot higher again, and following on the footsteps of Brazil and Turkey and some of these other emerging markets. This might end in some shock rate hikes that really put in the top of the currency market. So just keep that in mind, or I should say the bottom. That this could continue to go on for a little bit long, but I think looking out a year and a half, looking out 2 years, maybe you got to think that it's probably going to be a little bit better than where it is now. All right. After that exceptionally long-winded conversation, let's move on here. We'll look at Coronation. So, and looking at this thing, it kills me because I was shot short of it forever and didn't make any money. We've got the Coronation here, which is put in a real down day yesterday, kind of looking a bit like a rounded reversal, potentially coming down here to trade toward recent lows, but it continues to make the same sort of pattern and break lower. I think you can watch for this to happen again. They're definitely, if you look at this in a grand picture, I think they're trading almost twice what peers are trading at globally, and I don't think they're getting any real inflows. I know they got a massive position in Lonmin. If Lonmin were to go under here, if they were to try to announce a capital raise and end up going under, you could do a similar type story to Able. Remember, they were a major shareholder in Able. They came out of that looking really bad. If they do the same thing with Lonmin, I think it does irreparable damage to their reputation, and that could put the stock deep into negative territory from here. I wouldn't be surprised if it trade down to $50 on the back of something like that over time. So just keep that in mind. I think these guys have done a little bit of they've really got a lot of dirt on their face. I think there potentially you could see lower levels here. If this thing takes out the lows, I really think we're going to trade down to $60. All right, next one we'll look at is MTN, which you kind of think that this thing would be holding up better than some of the others, especially with the bounce that we had seen recently out of the oil price, the Iranian deal, the fact that this is a defensive, you're going into a hugely negative market, but nonetheless, it bounced up here to kind of fill the gap, and now you can see it's just kind of dropping out of a bit of a bear flag. It's definitely not looking very positive technically. All of a sudden looking like you're going to trade down to the lows. So just watch this one closely. I think we need to get above 180 to kind of negate this pattern again. FirstRand, I wanted to show FirstRand because this thing it's a major outperformer amongst the banks, but it's starting to struggle more and more, and you kind of see that there's no real bounce coming off this 50 level as you saw yesterday. Definitely starting to look a little bit head and shoulderish. This is obviously the household favorite in bank land here, but it's well below its 200-day moving average, consolidated below that. If it drops 50 here, this thing's going to come significantly lower. I genuinely believe that. So just watch. We did close here on this day at 50. So in terms of closing lows, we haven't had a closing low below 50 going all the way back to January. So, February, January. So. And that would give us a very, very large target at the downside, down to about 42. So just keep that in mind, 42 and change. It could be quite a lot lower levels here if we drop 50. The last one I'm going to look at here this morning is AngloGold, which is really putting in a bit of a narrowing wedge after bouncing up really hard off its lows and doing it right below 200-day moving average as well. But you can see here the moves have gotten smaller and smaller and smaller over the past couple weeks. And I think a breakout is imminent here. I think we're going to either make a move up toward 120 or we're going to make a move back toward 90. So just keep that on your radar. And that's it for today, guys. Good luck out there.